Let me ask you something that's really easy to think about. Think about what your parents had to pay for things when they were the same age as you. For example, a cup of coffee, a tank of gas, a bag of groceries, or a month of rent. Now think about what you have to pay for those things today. The prices are not even close to what they used to be. Every single year the difference in prices gets bigger and bigger. Every year the money you have can buy a less. Every year things cost a little money. Every year someone on television tells you that this is just the way things are. They say this is how the economy works and that it is just something called inflation. There is something they never tell you about. Inflation is not something that just happens by itself. It does not just come out of nowhere. Inflation is actually created by people. When it is created, someone gets benefits from it. That someone is almost never you, the regular person. Today we are going to talk about the people who actually get benefits from inflation. We are going to talk about where inflation comes from. We are going to talk about why the people who create inflation are very careful to make sure you never really understand what is going on with inflation and how it affects you and your money. Welcome to Finox Finance, where we talk about money and how it really works, not how people usually say it does. In this video we are going to talk about inflation. We are not going to use the definition from a book or what the government says. We are going to look at the thing. We want to know where inflation comes from, who it hurts the most, and who gets some benefits from it every time it happens. We also want to know what rich people do to stay safe from inflation, because most people do not know about this. When you finish watching this video, you will think about inflation in a way. You will not think it just happens to the economy like the weather. You will see it as a system that works. It does not work for you. Let us get started with Finox Finance and talk about inflation. People usually think that inflation is when prices go up. That is correct. There is something very important that people are missing when they think about what inflation really is. Inflation is not when things start to cost more because they are worth more. It is actually when the money you have is worth less. Think about this situation. Let us say you are in a room with 10 apples and you also have $10 in that room. Each apple costs $1, which is easy to understand. Now imagine someone comes into the room and adds dollars. Now you have $20 in the room. There are still only 10 apples. What will happen to the price of one apple now? The price of the apple will go up to $2. This is not because the apple itself changed or became more valuable. It is because the money in the room became less valuable. Since there is money now, each dollar can buy less. This is what inflation is. At its core, inflation happens when there is money in the economy, then there are things to buy with that money. Then there is a question that nobody really talks about out loud. Who added that money to the room? The answer is banks. In the United States, the central banks are the Federal Reserve. In countries, it is their equivalent central banks. These central banks are the institutions that control how much money exists in the economy of the country. When a government needs money to pay for things like wars or to fund programs or to bail out banks during a financial crisis, it does not always have that money. So what the government does is issue bonds, which are basically government IOUs. The central bank buys those bonds by creating new money digitally out of nothing. This is sometimes called easing, but what it really means is that more money was created by the central banks. When more money exists in the system, each dollar that already existed becomes worth slightly less. The central banks do this to help the economy. It can cause problems. Now you might be thinking, okay, surely the central banks only do this in extreme situations, like a big financial crisis. That is not true. Between 2020 and 2022, the United States Federal Reserve created money than it had in its entire history before that point. The money supply in the U.S. grew by 40% in just 2 years. That is an increase in the money supply. 40% is a lot. Then prices started rising in the U.S. People did not understand why prices were rising, so they called it a mystery. Economists debated it on television, trying to figure out why prices were rising. Politicians blamed supply chains and shipping costs in grocery stores for the rising prices. The math is not complicated. More money was created by the banks. Each dollar became worth less. Prices went up. The central banks created money, and that is the story. Now here is where things get really personal. Inflation does not affect everyone in the way. It is not fair to everyone. The people who get hurt the most by inflation are the people who have cash in the bank. This includes people who save their money in a bank account. It also includes people who live on an income, like retirees and pensioners. These people have to live on an amount of money every month, and that does not change when prices go up. It also includes people who get a paycheck. Their paycheck does not get bigger when prices go up. This is people. Let me tell you what happens to someone who does everything. They work hard. They save their money. They put their money in a savings account because that is what they were told to do. They save $50,000 over 20 years. Then inflation goes up to 8% for a year like it did in the United States in 2022. In 1 year that $50,000 can buy $4,000 less than it could before. The money in the account is still there. It is not worth as much. This happens without anyone taking money out of the account and without anyone asking if it is okay. The person who saved their life is now poorer than they were the year before. This is not because they made a decision. It is because of a decision that was made by someone and they did not get a say in it. Now let us look at someone who owns things like a house or stocks or a business. When inflation goes up, the value of what they own also goes up. This means they can still buy the things they could before and sometimes even more. The people who own things like this are usually the people who already have money. The people who save their money lose. The people who own things like houses and stocks win. Who owns these things? The people who already have a lot of money, like the people who own assets. The people who own assets are the ones who do well when inflation is high. The people who have cash in the bank, like people who save money, are the ones who do poorly. There is an idea about money that explains things perfectly. It is called the Cantillon Effect. The Cantillon Effect is one of the important ideas to understand how money really works, but almost nobody teaches the Cantillon Effect. Here is what the Cantillon Effect says. When new money is made, it does not just appear in everyone's pockets at the time. The new money enters the economy at a point, usually through banks or through the government spending money. The people closest to where the new money enters the economy get the benefit from the Cantillon Effect. Think about the Cantillon Effect like a river. You build a dam, release a lot of water. The people standing at the dam get the most water first. They can use the water to help their plants grow, fill their tanks, power their machines. By the time the water gets to the people at the end of the river, it is a little bit of water. The flood has already made the water level rise so much that their land is now partially underwater. That is exactly what happens with the Cantillon Effect and money creation. When the Federal Reserve makes money, it goes first to banks and financial institutions. Those institutions use the money to buy things like stocks, houses, and bonds before the prices go up. They get to buy these things at the prices with the new money. The value of these things goes up. They make a profit from the Cantillon Effect. By the time that new money gets to workers and consumers in the form of higher pay or government payments, the prices of everything have already gone up. They are buying things at the higher prices with money that comes last. The people at the top of the system, they win first from the Cantillon Effect. The people at the bottom pay the price last, from the Cantillon Effect. So what do the people who understand this actually do about it? They do not keep money in cash. Wealthy people and financial institutions use cash as a place to put their money for a time, not a long time. They put their money into things that go up in value when inflation rises, or even do better than inflation. For example, real estate is a thing to own. When inflation goes up, the value of properties and the rent people pay also goes up. If someone owns a property, the value of the property goes up and the rent they get from it also goes up. Their mortgage payment stays the same, so they win in two ways. Stocks. Owning a business are also good. A business that sells things can raise its prices when inflation goes up. If you own a part of that business through stocks, you own a part of something that can raise its prices. Over a time, the stock market has done better than inflation. Commodities like gold, oil, and food are also things to own. These are things that people need. Their prices go up when the value of money goes down. This is because it costs more to make these things. Index funds are a way for regular people to invest. They have done over time, usually making 7 to 10% more money each year. This is better than the rate of inflation over time. It is not hard to understand. The people who have money have known this for a time. They do not keep their money in cash, they own things. The formula is simple. Do not keep money in cash, own things like estate, stocks, and commodities. The financial system does not tell people about this because it is helpful for banks when people keep their money in bank accounts. So what does this mean for you in a sense? First, you need to understand what your savings account is really doing. Most savings accounts pay interest rates that are lower than the rate of inflation. This means that every year your money is in that account, it actually loses value even if the amount in your account gets bigger. You have to remember that a savings account is not a way to build wealth. It is a way to manage your cash. There is a difference between the two. Second, you should start thinking like someone who owns things of value, not just someone who has cash. You do not have to be rich to own things of value. You can buy into index funds, which let you own a part of many companies for a small amount of money. There are also real estate investment trusts, which let you benefit from the value of properties without having to buy a building. These are not secrets. They are things that most people do not know about. Third, you need to understand that inflation is not fair to everyone. It is not something that happens by chance. Inflation always takes value away from people who have cash and gives it to people who own things of value. Every year you have cash of owning things of value, you are losing out. Fourth, you should be careful when people say that inflation is because of problems with getting things from one place to another, or because companies are being greedy, or because of things that are happening around the world. Those things can make prices go up. When everything gets more expensive year after year, it is because there is too much money and not enough things to buy. The people in charge of money are the ones who control this, not the weather. Inflation is not a surprise. That it is a thing that happens. It takes money from people who have cash to people who have things. It takes money from people who are not good with money to people who are good with money. It takes money from people at the bottom to people at the top. Now you understand how it works. That does not mean you can stop inflation. Only people in charge of money can do that. You can make sure you are not losing money. You can stop keeping your money in things that lose value on purpose. You can start thinking about money like the people who created the system. Understanding how the system works is the step to not being tricked by it. If this video changed the way you think about money, subscribe to Finox Finance. Every week we explain how money works. We tell it like it is. No excitement, no quick fixes, just the truth. That if you want to learn more, watch our video on the salary illusion. We explain why your paycheck is made to keep you working and needing money. The link is there. We will see you in the video.